with the journal entries and the double entry. January 4th, bought goods on credit for 600 kwacha, right? So here we didn't pay any cash, we bought goods on credit. So we've now formed a liability, right? So we can say that's an increase in our liability. We have a payable, all right? And then since we bought goods, we have acquired an asset in the form of purchases, and an increase in assets is debited. So we'll debit the purchases account, right? We debit the purchases account, because purchases is an asset and an increase in an asset is debited. So we debit purchases 600, right? And then we're going to credit our payable, okay? Our payable is 600. So we're going to go to our purchases account, right? We debit purchases account 600, all right? This was January 4th. And we put here payable, right? Then we open up the payables account, okay? Right, so this is the payables account, payables. So we're going to credit the payables 600. Let me erase this here. Okay, that is our payables account. Right, we go to the next transaction. January 5th paid rent. All right, so the two accounts affected are the rent account and the cash account. Rent is an expense, and remember, an expense decreases capital, and a decrease in capital is debited. All right, so rent. Okay, so always remember, expenses are always debited. Okay, that's also another rule you can remember. Expenses are always debited. So debit the rent account 200, and our cash, which is our asset, has decreased. All right, so a decrease in an asset is credited. So it's a cash 200. All right, so we'll go to our cash account. Okay, we're going to credit, say here, rent 200. Right, credit our cash account 200. Then we open up our rent account. Okay. All right, so rent account will be debited 200. This was January what? Debit rent account 200. Okay, that was June 5th, January 5th, January 5th. Okay, and also here on our cash account, say January 3rd. Put January 3rd. All right. So then we got on January the 6th. All right. Sold goods for 650 kwacha. Okay. Sold goods for 650 kwacha. So the two accounts that to be affected are sales and the cash account. Right. Sales is the form of revenue, and we said an increase in revenue is, revenue increases capital, and an increase in capital is credited, right? And then since we're attaining cash, we're receiving cash, that's like an increase in our cash, which is an asset, so we debit the cash account. So I'm going to say January 6th. So we're going to debit the cash account because this is an increase in our asset. Debit it for 650. And we'll credit the sales revenue. Okay, sales. Maybe we'll just put in here sales revenue. We'll credit it 650. All right. So we're going to have to open up our sales account. Okay. We have to open up our sales account. Okay, let's see if I can open it up this side. Alright, so we right, sales, we're going to credit sales 650. Okay, 650. Okay, details here. This goes cash account January 6th. January 6th. And then we come to the cash account. All right, we're going to say January 6th. Okay. Sales 650. So those are our journal entries and our postings. Okay, let me just put it like this here. Our journal entries, remember, the one which is debited comes first. Always one which is debited is put on top, and then the one credited is put below. Credit.